Okay, today's lecture is called The Time Value of Money. This one's going to be a little bit different than our other lectures, and you don't actually see a chapter in your book called The Time Value of Money, but we use the time value of money in both financial accounting and in managerial accounting. In financial accounting, we have to use time value to calculate the value of bonds that we issue, leases, long-term leases, and pensions, among other areas. And in managerial accounting, when we analyze big investments, what we call capital investments, okay? For example, when airlines buy a bunch of airplanes, build a new building, invest in large equipment, these are substantial investments. We have to factor in the time value of money in helping us to determine if this is a good investment opportunity or not. So we're going to look at, in a subsequent chapter, something called capital investment analysis, and that uses the time value of money. So this lecture is going to be for those students who want a little bit extra background in time value, and I'm going to reference this lecture when I talk about capital investments. Okay, the time value of money has a basic premise of the fact that interest increases the value of money. So if you put $1 in the bank today, a year from now you'll have, assuming you can earn 10% interest, you'll have $1.10. And so what we say is $1 today is worth more than the same $1 a year from now, because if you put the money in the bank today, a year from now you'd have $1.10 as opposed to $1. So $1 today is worth more than $1 to be received in the future. And from that basic concept comes two terms that we're going to use called the future value of money and the present value of money. Now let's take a look at the slide. Most textbooks will have time value tables in one of the appendices in the back of the book. Sometimes they'll just have present value. Sometimes they'll have future value. Go to Google, do an internet search, type in time value tables, and there are actually 6 tables. Now we're only really going to use 2 in managerial accounting, but I simply want to mention them. If you're a finance major or an accounting major, it's something you want to be familiar with. Notice there are 3 present value tables and 3 future value tables. And I'll mention all 6 of them briefly, and then we'll focus on the few tables that I'm going to use for this lecture. Okay? The interest rate that we use is the rate that we think we will earn. Or in the case, if we're considering an investment proposal, what is our cost of borrowing money, what we call our cost of capital? And most companies will establish something called a minimum required rate of return on investment. If we can't generate at least, for example, an 8% return on investment, there are probably better opportunities out there. So we set a minimum required rate of return, sometimes called a hurdle rate, to clear the hurdle in order for us to actually invest in this proposal. So this is ultimately what we're considering in capital investments. Okay, so let's first talk about the future value. Now, notice it says the future value of 1. And what that means is, and sometimes they'll use the term lump sum. We're going to invest a certain amount of money in the bank today, just one time, and we're going to see what is it going to be worth a year, 2, 3, 4 years down the road. So let's take a look at this example. Assume that we invest $1,000 today for 3 years, and we can earn 10% interest, assuming what's called annual compounding. Okay? Now, let me just briefly mention, interest can either be simple interest or compound interest. Simple interest, in this example, would mean each year we would earn $100 interest. Compound interest says in the first year we earn $100. In year 2, both the $1,000 investment plus the $100 of interest that we previously earned, that's $1,100, that full $1,100 will now earn interest. Okay? And that will give us $1,210 at the end of year 2. Okay? That's compounding. Now, that $1,210 at the end of year 2, all of that full $1,210 will earn interest at 10% for 1 more year, and at the end of the 3rd year, we will have $1,331. So now, I'm going to switch to what's called the future value of 1 table. Okay? You're going to see what this thing looks like momentarily. And we're going to see how can we easily calculate these numbers, because 3 years is pretty basic. What if I said 30 or 50 years? You don't want to have to sit there crunching numbers 50 times in a row. We can use a simple table, and business and scientific calculators do this very quickly. If you have one and you know how to use it, that's fine. Okay, so let's take a look at the future value of one table right here. All right, now, notice it says future value of one table, and they may go by slightly different names, but this is a pretty common name for this particular table. This is when we make a one-time investment. Now, notice these numbers. Here's the 10% column, okay? And here's the periods, which in this case will be years. And I don't know if you'll see this very well, but I'm going to highlight this. And notice in the third row, 10% column, here's the future value interest factor, okay? And so what I do is I multiply my $1,000 investment times 1.331, and that'll give me 1331. And so instead of doing 3 calculations, I can do 1 calculation. Now, suppose we were to say, what would $5,000 be worth 6 years from now if I could earn 9%? Well, I would take $6,000. Here's the 9% column. Okay, multiply it by the 5 or 6 years. So $5,000 times 1.6771. So again, if I can invest $5,000 and I can earn 9% for that 5 years, perhaps it's a CD of some sort, 6 years from now, I would have 5,000 times 1.6771, and whatever that number comes to, $9,000, whatever it may be. Okay? And so these tables can make things very easy. Now notice what we did is we started with an amount today, and we were looking into the future. What will this amount be worth in the future? That's a future value of money calculation. We can, and by the way, when we're going forward in time with interest, we refer to that as compounding. Now, we can also kind of do it in reverse. If I know 3 years from now I'm going to need $1,331, what would I need to put in the bank today, assuming I can earn 10%, so that 3 years from now I would have $1,331? Now what we're doing is we're taking a future amount. I need $1,331 3 years from now, and I'm trying to figure out what is that worth today. In other words, what do I need to put in the bank today, the present value, today is the present, okay, so that if I can earn 10% on that mysterious number, I'll have $1,331 3 years from now. We're reversing the effect of compound interest, and the term we use is we are discounting. So when you go forward in time, you're compounding interest, and when we're starting with a future amount and I'm coming back to the present, we call that discounting. So some people try to determine if they have a young child and in 15 years that child's going to college, and they say, well, 15 years from now we're going to need $100,000 to finance their education. How much do we need to start investing? Okay? And you can do this with a one-time investment, a lump sum, but more commonly people are going to put money into a savings account of some sort, and we're going to talk about that next. That's called an annuity. Okay, so let's take a look at this example here. Present value of 1. Okay, 1331, that's from our previous example. And I want to know what would I put in the bank today. So watch what we're going to do. And these numbers should look familiar. Okay, at the end of 3 years, I would have 1331. Well, what would I have at the end of 2 years if I was earning 10%? I would have 1210. So I simply am reversing the effect of compound interest. And notice what I'm doing. 1331 divided by 1.1. That's 1 plus my interest rate of 10%. If you multiply a number, 1331 times 1.0, it's obviously 1331. That means we're earning no interest. So 1.1 means I'm earning 10% interest on the principal. The 1 is your principal, the 1331. So at the end of 2 years, I'd have 1210. Well, 1210, if I discount it back one more period, at the end of the first year, I'd have $1,100, assuming 10%. And that means if I discount it back one more period, today I would have to put $1,000 in the bank so that 3 years from now I would have 1331. Now I know you already knew that number from the previous example. Now, suppose I said we want to have $1,000 3 years from now. All of a sudden, it's like, well, now I don't know what the number is, but what I can do is I can divide 1,000 times 1.1, and then that would give me 909. I happen to know that number. Then I would take 909, I would divide it by 1.1, that would give me 826. And then I would take 826 and divide it by 1.1, and that would give me 751. Okay, now I'm going to come to the board. I just want to show you something. Okay. So, here's a timeline. Here's $1,000. Now, the question is, what would I need to put in the bank today so that 3 years from now I would have the $1,000 that I believe I'm going to need for some reason or another? And so what I said a moment ago was I could do a couple of different things. I could do this. 1,000 divided by 1.1 will give me 909. That's what the amount would be worth at the end of the second year. Okay? And I'm just reversing the effects of compounding from what we did earlier, the future value. Then I would take 909, divide that by 1.1, and that would give me 826. Okay, and then last, I would take 826, divide it by 1.1, and that would give me 751. And that's how much I would need to put in the bank today, assuming I can earn 10%, so that I would have the $1,000 that I need 3 years from now. And go ahead and prove that on your own. If you multiply 751 times 1.1, I'm earning 10%, you get 826. 826 times 1.1 will give you 909 at the end of the second year. And 909 times 1.1, you'll have your $1,000 at the end of the third year. Okay? Now, I'm going to erase this, because what I'm trying to do is I want to show you that the numbers in these tables are all related in some way or form. If I were to take the number 1 and I divide it by 1.1, I'm going to get 0.909. If I take 0.909 and I divide it by 1.1, I'm going to get 0.826. And if I take 0.826 and I divide it by 1.1, I'm going to get 0.751. Okay? And so these numbers should all look somewhat familiar. In fact, you could do this. 1.1 to the third power is 1.331. And 1 divided by 1.331 equals 0.751. Now, I know I'm throwing a lot of numbers at you in short order. You can hit pause, and if you look at the numbers, you'll start to see a relationship. Okay? Just take it one step at a time. Okay? And so this is the future value calculation, which we saw in that table. 1 times 1.1 is 1.1. 1.1 times 1.1 was 1.21, and 1.21 times 1.1 is 1.331. And then notice, this is simply the reverse process, the reciprocal value. I'm going to go back to the computer, and I'm going to show you the present value of one table, and you're going to recognize these numbers. Here, I'm going to circle these numbers. Okay? And I'm going to head back to the computer. Okay, now here's our second table, the present value of one table. Okay? And look at the 10% column, and look at rows 1, 2, and 3. These, again, these are called present value of one factors. 0.909, 0.826, 0.751. Now these are infinite numbers, of course, so a table has to cut them off at some point. Your calculator can do infinite calculations, meaning the decimal just runs on and on. Okay, and so all these numbers come from somewhere. Now, this is not a random number generator. Okay? Same thing if I were to do 12%. 1 divided by 1.12 would give you 0.8929. 0.8929 from the 12% column divided by 1.12 would give you 0.7972, etc. Okay? So now, suppose I said 10 years from now, I'm going to need $100,000 for my child's education. I believe I can earn 8%. Okay, and these tables can go out to any percentage you want, and of course calculators can do that as well. So I want to have $100,000 10 or 15 years from now, whatever I said, 10 years from now. I would go to the 8% column, if that's what I believe I can earn, and the 10th row, and what I would do is I would multiply $100,000 times 0.4632, and what that means is if I invest $46,320 today, and I can earn 8% interest compounded for 10 years, I'll have $100,000 10 years from now. Now this ignores the fact that we would have to pay tax on interest, okay, so that in real life we have to factor these things in, but that's the basic concept between present value calculations and future value calculations. Okay, in this example I said, in the future, 10 years from now I want $100,000. What would I put them back today, assuming I can earn 8% so that I'd have $100,000? I'd put $46,320. Okay? If I wanted $1,000 3 years from now and I can earn 10%, okay, there's that number, 0.7513. Okay, I just did 3 decimals on the board, but there it is. So I multiply 1,000 times 0.7513, and I get $751.30. Now remember, very important, any of these tables you use, you always multiply your number times whatever the factor is to determine the future value or present value. Always multiply. Okay, so this is when we have what we call a lump sum, a one-time investment, whether it's going forward, future value, or coming back, present value. More often than not, we're going to have something called an annuity. What is an annuity? An annuity is a series of 2 or more payments that occur at equal time periods or time intervals. So it could be weekly, it could be monthly, quarterly, semi-annually, annually, but that time interval, let's just say annual, has to be 1 year, 1 year, 1 year, 1 year, and 1 year. Now, if you're an accounting major or a finance major, you'll need to know that annuities can either start at the beginning of a time period or at the end of a time period. Okay, for example, when you make lease payments, the lease payments are typically made at the beginning of a period. However, if you're paying interest on a note that you borrow or a bond that you issue, interest is paid at the end of a time period. So we'll see that there are different scenarios and different transactions in business where we have to calculate payments based on the beginning of a time period or the end of a time period. Notice, if you make or receive a payment at the beginning of a time period, that's referred to as an annuity due, D-U-E. Okay, and there's present value annuity due table and a future value annuity due table. If the payment is going to be made or received at the end of a time period like interest, then we call it an ordinary annuity. So you have a present value ordinary annuity table and a future value ordinary annuity table. And then notice, we're only going to use ordinary annuity calculations for this lecture. So you are aware that you could have beginning payments or ending payments. We're only going to use ending payments. Okay, an ordinary annuity table. Let's first look at a future value ordinary annuity calculation. If I deposit $5,000 at the end of each year for 3 years, and if I can earn 8% interest, how much will I have at the end of 3 years? Okay, well, we can do this a couple of different ways. December 31st, I deposit $5,000, and then in year 2, I'm going to earn 8% interest on that. At the end of that year, I'll have $5,400, 5,000 plus 400 interest. Then I'm going to deposit the second payment of $5,000. So now I have $10,400. And that's going to earn, $10,400 is going to earn 8% interest, and that'll be whatever that number is. We'll find out in a moment. And then I'll make my final payment of $5,000, and that'll be the number, the value that these payments will be, 3 payments made at the end of a period 3 years later. Now I'm going to go to the future value ordinary annuity table. Okay, I'm going to go down to the 8% column. Okay, future value of future value of an ordinary annuity. And here's my 8% column. I'm going to go to the third row, and we call these numbers factors. My future value ordinary annuity factor is 3.2464. So I'm going to go back to the PowerPoint slide now. $5,000 times 3.2464, right here at the bottom. At the end of 3 years, I would have $16,232. And I intentionally chose 3 years, so if you want to try to prove this, you can do so. In fact, let's go ahead and do that just so this helps reinforce. I'm going to head over to the board. Okay, I want to take the long route to prove that we will have $16,232 because I want you to see how these tables work. All right, so at the end of the first year, I deposit $5,000 and I can earn 8%. If I multiply 5,000 times 1.08, I will have $5,400 at the end of year 2, excuse me. Now I'm going to make that second $5,000 deposit. Remember, this is an annuity. Okay? So at the end of year 2, beginning of year 3, I now have $10,400. I'm going to need a calculator for this. So $10,400 times 1.08. At the end of the second year, I'll have $11,232. And then at the end of the third year, I'm going to add my final deposit of $5,000, and there's my $16,232. Now remember, this was an ordinary annuity, which means the payments were made or received at the end of each year. Had it been an annuity due, we would have started with a calculation where each payment is received at the beginning of the year. Okay? So there it is. There's my $16,232. A lot easier just to go to the tables, or if your calculator does in present value and future value calculations, it's a relatively easy calculation. Okay? Now again, suppose I said, well, I want to deposit $5,000 for the next 40 years. Well, you don't want to have to do that by hand, so these tables are very, very useful. Okay, I'm going to head back to the computer. Okay, and now we're going to do a present value ordinary annuity calculation. Assume that we know we're going to have to make 3 payments of $5,000 at the end of each year. Okay, for 3 years. Assuming I could earn 8% interest, what would I have to put in the bank today in order to be able to make these payments as they come due? Okay, now, there's a couple of different ways we can do this. Let's go to the present value ordinary annuity table, 8% interest, and again, I will give you that interest rate, and it'll usually be something to the effect of the rate that we know we're going to earn, or a minimum required rate of return that the company requires, or the cost of capital, the cost of borrowing money, but we'll know what that interest rate is. And I did say 3 years, so we'll go to the third row, okay, and then $5,000, 3 payments to be made at the end of 3 periods. So I go to the table, and I'm going to go to that table right now. Here is my present value ordinary annuity table. Here's 8%. Okay, and for 3 periods, I see 8% column, third row, 2.5771. Okay, I'm going to go back to the PowerPoint slide, and there it is. So I multiply $5,000 times 2.5771 to find the present value of these future payments. In other words, if I deposit $12,885.50 today, assuming I can earn 8%, I will be able to make these 3 payments of $5,000. So now we're going to go to the board and we're going to prove that we can actually do this, that this actually works, okay? So let's prove that this is going to work. I deposit $12,885 in the bank today. Okay? If I can earn 8%, at the end of the first period, I will have $13,916.34. Okay? Now, I'm going to make my first $5,000 payment. So I'm going to subtract $5,000, and that's going to give me $8,916.34. I would normally round to the nearest dollar, which would mean you'd have a slight rounding error. Okay, so now let's subtract 5,000 from 13,000. And now I'm going to multiply 8,916 times 1.08. That's going to give me 9,629.65. And again, go ahead, calculate this on your own, confirm these numbers. It's the end of year 2. I'm going to make my second payment of $5,000. Which will leave me with $4,629.65. Okay, this $4,629 will now earn 1 year's interest at 8%. So I multiply that times 1.08, and I get $5,000, which means I can make my third and final payment. I'll have 0 left, but there it is. I can make my 3 payments. Okay, so the present value tables simply make life a little bit easier. And so I find the interest rate column. I go to the number of rows based on years or months or whatever the time period is, and I can quickly and easily calculate what the present value is. Now, in financial accounting, I would use this because I know that if I issue $100 million of bonds, and I'm paying 8% or 7% interest, I know that every year for the next 25, 30 years, I have to make those payments. I can figure out the value, the present value of all those future payments. Remember, you don't just add up the numbers because $1 today is worth a lot more than $1 5, 10, 15 years from now because of the effect of compounding interest. And GAAP requires that we do this, generally accepted accounting principles. Okay, so I'm going to go back to the computer. Okay, the last thing I want to point out is with the present value tables, the ordinary annuity table is simply a shortcut. If we use this example where I know that at the end of year 1, end of year 2, end of year 3, I have to make a $5,000 payment, I could do that one of 2 different ways, and I want to just point that out. So if I were to go to my present value of 1 table, using 8% as our example, I could multiply the end of year 1 payment. I'd go to the 8% column, first row. I could multiply that times 0.929. Then I could take that second payment at the end of year 2, $5,000. I multiply that times 0.8573, 8% column, second row. And that end of third year payment of $5,000, I would multiply that times 0.7938. Okay? And that would give me whatever that number was. I forgot what the number was. But what I can also do is if you were to add up, and I'm going to ask you to do this, add up 0.9259 plus 0.8573 plus 0.7938. Okay, and let's go ahead and do that. Okay, I'm going to do that along with you. So we have 0.9259 plus 0.8573 plus 0.7938, and that gives us 2.577. If I go to the present value ordinary annuity table, okay, look at the 8% column, third row, there it is, 2.577. So this table is simply a shortcut rather than have to calculate 3 individual calculations, which you can do, I simply go to the ordinary annuity table and I make one calculation, and I would get the same result. Okay, so when we look at capital investments, we're going to be using present value tables, because what we're doing is we're analyzing what's the attractiveness of a future proposal, and we say, well, we believe, for example, this investment will generate profit of $50,000 a year in year 1 and $60,000 in year 2, $70,000 in year 3, etc. We bring back all those future payments to their present value using what we think is, for example, the minimum required rate of return, and we see, are all those future cash flows going to cover the cost of the investment? Is it a worthwhile investment? And that's why we need these tables. Okay, and that's it.